Howdy folks, Mark here back at you from Flipside Trading, and here we are to talk about the trades of April the 6th. Now the first thing we did, you can see that I entitled this Whirlwinds and Whipsaws because based on the whirlwind Twitter storm out there, it has definitely led to whipsaws in the market, right? We're up 300 points, we're in 1 second, we're down 300 points in the next news cycle. So it was a very crazy week. But most of that pressure, has been downward, and you see that in our trades, we had 3 put verticals. So the question really becomes that we'll dive into is, if the market has a lot of downward pressure, why are we doing put verticals and then just one call vertical? So you can see, but based on that strategy, we were able to achieve our goal of $1,000 by pulling over 1,300 on just 4 trades. So let's take a look at what the market had to offer. Let's go here to, first of all, I have to get out of this. There we go. Okay, what we have is a chart here, the QQQs. This is one of our put verticals, but we're also going to use it for a discussion of overall market sentiment. You can see here that we had, this bullish downward pressure. Let me get you a little arrow here, right? Everything is moving down. We have this type of support at the moment, but why here? Why are we going to stop? So there's a number of different things to take a look at. Number one, remember we've talked about symmetry in the past, and you can see here that this downward move is almost exactly 100% of this downward move, which is an indication that potentially the market has reached its run. In addition, take a look at these last couple candles. You see these wicks to the downside, right? We got a wick here, we got a wick here, we got a wick here. We're never closing on the low, so it's kind of like a butterfly with sore feet looking for a landing in order to find a bottom. So there's another signal of potentially why we want to be bullish. In addition, let's take a look at the market internals, because they also have some, should we say, signals to tell us why things may be bullish. Okay, here we are with the VIX, right? The VIX right here is our market uncertainty gauge, and you can see that this red band here is the Bollinger Band, and that the VIX is staying within it. It popped out, it stayed closed down within, and now it's kind of pretty much traveling across. So this is saying that we've reached some type of potential stabilization of the over volatility direction, right? Not the volatility from a plus or minus in a true range standpoint that exists in the day. So there's one. Number two, we have the skew. When we look at the skew here, when the skew gets above 135, it's usually more of a bearish type of an indicator, meaning that the market needs an adjustment. But when it gets down here to 118, it says, whoa, hey, we're a little bit oversold. So be on the lookout for a potential turnaround. Let's move on to our next internal indicator, the put-call ratio. Here we are. We're at 1.2, which is saying that the puts to the calls are outnumbered at a ratio of 1.2 to 1. So the whole market, from a sentiment perspective, is decidedly bearish. In addition, this is the big one, right? The 10-day moving average is also above 1. Again, saying that we're probably oversold. And lastly, we have the trend. And we're above 2 for a number of different times for a period of time. And so again, it's saying that we're oversold. So if you put all these things together, right, these market internals in association to what we've seen on the symmetry of the market, and you're like, okay, this makes pretty good sense. Now there's one other concept I'd like to bring into play here, and that's what's known as skew in association with puts and calls. So I'm going to bring up an option chain, and this is for this Friday. This is for the QQQs, right? Same thing we're talking about before. Yeah, see it right here. Here we are, April 6th, expires this Friday. Now, what happens, there's a skew in premium between puts and calls. So if we go, right, 4 strikes out. So we go 1, 2, 3, 4, we'll go 5 to 159. You can see that we're selling, right, if you take the mid price between 106 and 111, that if we sold this put, that we'd bring in about, $1.08 worth of premium. Now, let's take a look at the call side. Again, let's go 5, right? 1, 2, 3, 4, 5. It brings us to the 163. Look how much premium we would bring in, 22 cents. I'm bringing in almost 5 times worth of premium, right, with the same direction, the same distance between the at the money strike of 161. So selling these puts is much more profitable situation than selling the calls. So when I have all the internals aligned to say that I can actually sell puts, in most cases when I see this skew, that's the direction I'm going to favor in because, hey, bigger bang for the buck, right? Okay. In addition, I can now move out, right? I can move out to, if this was 5 strikes, I could move out to 7 strikes and still bring in 63 cents, which is more. So now I have a much greater cushion / margin of error when I go ahead and choose my short strikes. And let's take a look at how we choose those short strikes. So let's get out of this and I'll go back to our trade station. Now I'll go back to okay. So the first thing we're going to look at, we'll get rid of this, right? Our symmetry, we don't need that anymore. Kind of clutters the discussion. You can see that we have support right here at the 150 level. Now that 150 level is what I call protective support. It serves as a barrier to price, right? It respects it. So we're looking at for at least a pause, hopefully, kind of as protection before it moves any lower. So now why the 148? Well, the other thing you have to look at is we have a gap. Right? What if I'm wrong, right? So I want to put it right at 149. But if the market has this, propensity to go ahead and close gaps. So if it wants to sneak right down and close the gap, if that happens, it usually will bounce off. So it gives me a little bit of a cushion, right? I expect that it would hit it and bounce. So the combination of, this protective support and this is the overall gap fill allows me to choose the 148. And you can see that the market performed, as we talked about. Now you notice that we set this on April the 2nd, which is a Monday, and the options were set to expire on April the 6th. Well, given the way the market is fluctuating and we have this whirlwind and firestorm back and forth, we took 50% of the profit. So there's nothing like setting that good to cancel order right after you place the trade. And this was actually the next morning. It happened, right here. We got that bounce, and by 10 o'clock, the little ding goes off, and boom, money in your pocket. And it takes away all the risk, takes away all the anxiousness, because you just don't know what the market's going to do. Okay, so that was QQQ. Let's take a look at Tesla. So Tesla, again on the daily. Let's look at a couple different things. Let's look at the wicks here on the candlesticks, right? They are very much mirroring what we saw on the daily indexes in the sense of it's kind of setting down and it's hitting a price level and it's not holding, right? The bulls are taking back over and they're rejecting these lower price levels. But is there really support here? Well, let's look at a different time frame. Let's take a look at the weeklies. So if we go ahead and take a look at the weekly time frame, and we'll go right here, you can see that, look, we have this support, right? The way to be right is to look left, and you look and you see all these different pivots and support areas, right through here. And guess what? We're starting to bounce off that. So it's saying that this is a pretty valid support level. So what we'll do is based upon, I'll say just the momentum, and we'll take advantage and put us kind of in the 85-90%, is that we set our short strike at 215. Again, these options didn't expire till the end of the week, April 6th. We placed the trade on Monday. We put our 50% level in, and boom. The next day, the numbers came out from Tesla on production. They weren't as bad as they thought. It overcame the off-color joke of Elon Musk's April Fool's piece on hey, this company is ready to go bankrupt, and we were good to go. We were able to put money in our pocket. Okay, so let's go back and take a look at SPX. And let's get off these screen draws. Let's make sure I can get back. So let's see, here we go, SPX. Right, that's the weekly. You can see we have our protective support level, right here at 25.32. And that's important because our short strike that we chose was 25.20. If you remember all the other things that we talked about symmetry and the 4 market internals all lining up, plus this protective support, provide an overwhelming, should we say, edge to say that we knew the market was going to, had a high probability to bounce, right? We never know for certain. So we set it for, our short strike was at 25.20. Now, one of the things that you have to, consider is I had 3 put spreads, and here I am, betting all in one direction, right? Semi-bullish. Well, that's just not healthy. So the idea is we had to think about what would happen if we were wrong, right? We need a hedge. And so that hedge took the form of a call vertical in the SPX placed on the same day. And we'll take a look at it in the 5-minute chart. And we'll go back here. All right. So here's the day we placed those trades. So the first thing we did, just as before, we took a look and we said, okay, it seems like we have a little bit of an uptrend here. We're going to go ahead and, we have this bottom. Price broke, the moving average stack, stayed intact. IMM stack, the ADMA stayed above the 21, stayed above the 34, and it was moving up in this direction. So this is a good time to place, right, our put credit spread when price is low. We want to do that when price is low because then we can move down and gain premium, farther away and have a greater margin of error right down to the 25.20. So if you take a look, we're setting this at 25.76. Let's just say it's 25.80. So we got a 60-point, cushion. Like I said, we're looking to place a hedge. Now, why are we looking to place a hedge? Well, again, let's take a look at what the market has to tell us. Right? This looks like an uptrend, but let's take a look at our symmetry again. If you take a look at our symmetry from this bullish move compared to this bullish move, you can see that it never reached it, right? That this reach is smaller, suggesting that things are going slower. By suggesting it's going slower, there's another way to look at that. And let's take a look at these histograms. You can see that this histogram on this first reach was the longer reach, was much larger, right? Not only was it taller, but it was broader, right? Versus the second reach, it's much smaller, right? And we have a little bit, you can see it here, of this divergence, right? So always look for divergence. So it's saying, hey, we've reached this top level right here. This is a good place to place our hedge. And that's we placed our hedge at 25.65. So the trade went through. You can see we came at 26.20. I think we overall closed today. Let's go all the way to the end here. Sorry, I have to get out of the screen draw to make this work for you. And jumping all the way over. You see we closed at 26.48, which was great for our put credit spread. Also well below 24.65. Both those expired worthless. And that's how we're able to pull in $1,315 in premium based on 4 trades. And that's why we were bullish in nature. Hope that helps explain what we're doing and how we're doing it. Hope you learned something. I'm not going to put any trades on later this week, at least because head up to the hills. I got some good friends coming into town. And Expiration Fridays when I really need to babysit those. So we're kind of wrapping it up. All right, guys. Have a great weekend. Catch you on the flip side.